Friends, welcome to this webinar of Milestones to Wealth. The idea of hosting this webinar is very simple. It is important that investors are taken on this journey of achieving milestones by making their saving habits sound, investment habits stronger, and economic beliefs more grounded. Investing is not a game of chasing dreams or a wild goose chase. It is a very precise, conviction-driven journey which you have to make. And in that journey, there should be a lot of preparation, anticipation, and response. 2023 is a year which is going to demand far more preparation, anticipation, and response. But the good news is this year will belong to the savers. So it's important that you should create a great saving habit in this year and use that saving habit to power your investing long into the future. Because if you're able to cultivate that habit at the right time, then you will be able to do very well for a very long time. Let's go to the next slide. Why do I say this? Why do I say that 2023 belongs to the savers? Firstly, I expect this year to show a lot of volatility. You have the Adani IPO coming up next week. Then in the week after, you have the budget. You are going to see a lot of FII behavioral changes throughout the year. In April or May, you're going to see the MSCI reset in the index when HDFC Bank merger is going to get affected. The government is lagging behind in disinvestment, so it has to come and do a lot of selling of companies in course of this financial year and calendar year. So all this would mean that there will be a lot of selling, and by virtue of such high selling of shares to the public, that will contribute to volatility. People will always sell their shares to buy other shares, which are being sold again by the government or by issuers. So volatility is going to be very high. Also, the opposition will galvanize its strength to take on the government in 2024. That is also going to create uncertainty in the minds of investors about the election result of 2024. So all this will start in 2023 itself. But this volatility is the opportunity because people will not buy stocks at any price. There will be hesitation. Many people who blindly bought stocks in 2022 because returns from debt, fixed deposit, etc. were low, will go back to fixed deposits in 2023. So all this will create volatility in the stock market. But that is when you should seek opportunity. You must buy when there is volatility. So it's going to be a year of wait and watch investing. So you need to buy steadily. Whenever you have money, you have to buy a little bit, invest a little bit. Good old-fashioned investing is what you will do in 2023. It's a classic wait and watch investing. But you should not wait and watch doing nothing. At every opportunity, you have to make some investments and wait for the next investment by collecting your savings again. In farming, you say that there is a time to sow, sowing season and harvesting season. 2023 will be sowing season. In my view, 2022 was actually harvesting season, especially in small caps. But nobody listened. But those who sold the small caps in 2022 are going to be very happy in 2023. 2023 is a sowing season where you're going to invest across caps, whether it is small, mid or large. When to invest in which cap is going to be a challenge, but it's a sowing season. You have to invest now so that you will reap rewards later. Your harvest of profits will happen in the subsequent years, 1 or 2 years down the road. So this year is definitely a year of sowing. One interesting thing in 2023 is going to be that valuation and risk will move in the same direction. So I expect valuation to move down, and naturally risk will also move in the same direction. It will go down a little bit. And that's a good direction if it moves that way. I don't expect it to remain going up like it has in the past. How do you achieve outperformance? This is the problem for a lot of investors. You would have seen that in the last few days, people are comparing PMSs with the Nifty and with various benchmarks and saying 70% of the people are not performed. I'm sure the media will do it with mutual funds also. It's very fashionable to say that outperformance is not there. But what we need to understand is if you want outperformance, there is a need for a lot of hard work. You can't put money in a mechanical and dumb way and hope to beat index. It's not possible. You need to practice intelligent investing all the time. You cannot practice dumb mechanical investing. So how can you do that? When the markets are down, when no one is willing to buy, you must scale up your investments. For that, 2023 is going to be a good year. So if you're a good saver and you're always collecting money and keeping it ready to be invested when the chips are down, when the markets are down, when sentiment is weak, then that money will go in at a valuation which is attractive and will, as a result, earn your outperformance against whatever you're comparing, against inflation or against the benchmark. One important thing in 2023 is the choice is going to be very, very high. You are spoiled for choice. There's going to be opportunity in every part of the market, whether it is large cap, mid cap, small cap, tech, banking, commodity. In many parts of the market, there is going to be opportunity because all parts of the market will gradually become more attractive as the year progresses. Let's go to the next slide. So let's see the overall market outlook. Interest rates are high today. Housing rates are very high. General interest rates are high. Money market is slowly becoming tighter. So once the government gives its borrowing plan, I expect money market to become even more tight. Inflation is coming down, but it is still there. It's not as if it has come to a zone of comfort. It has just come within the RBI's band. RBI wanted to keep it between 3 and 6%. It was higher than that for a few quarters in 2022. In 2023, we have begun with the good news that the inflation is within the RBI's upper limit of CPI. WPI has come down a lot, but that could also be a lot due to the base impact because last year it was a higher base. So inflation is moderating, but it is still there. We can't say that inflation has been defeated, that we can now go for growth. That phase is still some time away. It's not immediate. System liquidity is neutral, but I expect the liquidity to become tighter. So that is what it is looking today. But at the moment, it's neutral. In India, fiscal deficits are on track. The government is likely to only overspend to the extent they indicated in the budget. So whatever they told in the budget, I think they will achieve. So that is actually very good news. Since 2019, this is the good news that you can say about our budgets. Earlier, for a very, very long time, every budget would overshoot the deficit which they project. But the last 3 years, I think the projections are made very intelligently and the management is also done reasonably well. And as a result, the fiscal deficit is constantly on track. But having said that, India is shooting very high fiscal deficit compared to what we should ideally be doing, which is 3.5%, but we are shooting 6.4%. So, and we are 6.8. No, it's very high. Slowly, it is going to go down. So, I think that the journey towards that acceptable range of fiscal deficit will happen over the next government's term. So, it's going to take an entire term for us to come to a level where fiscal deficits are within an acceptable range. So, you're still having 5 years of investing to be done, which is a good news according to me, because the reason why the fiscal deficit is being overshot is because the government is investing. Last year, that is the current financial year, they are investing 7.5 lakh crores It's way above the investments done under NDA 1 or under the 2 UPAs. And this year it is expected the government's infrastructure investment plan will be 9 lakh crore. Fantastic number. The benefits of all this will accrue in the future. So the fiscal deficit is, in my opinion, acceptable because of these kind of decisions which are going forward, okay, which will take us to a better place. I expect equity markets to be volatile. I had mentioned to you this, that markets will not be soft. There will be a lot of movement up and down, and in specific stocks you will see very sharp movements. News flows, macroeconomics, global fund flows, everything will affect. And global growth is decelerating, which means when the valuation come down in the global markets, global investors may actually sell their shares in India and take the money out. That has been happening last year. It may continue this year also. Trends so far indicate it is still happening. So the budget has to kind of soften this. If it fails to soften, then the global selling in India will continue, because global growth is not good and they need to take money out of wherever it's deployed outside. Our Indian markets are fairly valued. I won't say that the overall market is attractively valued. The overall market is fairly valued. It's not expensive, but it's not cheap either. So your decision has to be made at individual stock fund level. So I don't think blindly putting money in whatever you like will make money for you. So it's going to be a very different stock market in 2023. This is an important point. Divergent global monetary policy. I think India will probably have better control over inflation, and as a result will have a more benign interest rate scenario than the world. I think the West is going to take much longer. The struggle is much higher. That is my sense. But we'll have to see. So there could be divergent global monetary policy to what we are going to have in India. Let's go to the next slide. So this is the macro outlook. Global growth slowing down, tighter monetary policy, rates are going up, liquidity will come down. Inflation environment still is high globally. Currency order is changing. I think US dollar this year may see some challenges. It did not earlier. And in this currency order, there is not going to be cryptocurrency at all. Whereas in 2021, people were looking at cryptocurrency as an option. And credit offtake is going to be the highest in a decade. This is in India. Loan growth is going to be very high. Globally also, I think credit needs will be high because money is becoming scarce. They're tightening, right? So credit offtake will be there, and interest rates going up will mean business, trade, everyone needs more capital. But this is not bad actually. When you see this kind of a challenging macro outlook, I always think that it's an opportunity to buy. Let us see how we can buy in the next slide. So whenever equity markets go up, you can book some profits, make sure your notional returns are realized, and then wait for opportunities. So if something goes up too much, you have to sell. Like I have been telling people that last year they should sell small cap and mid cap. Last year was a good year to sell. If you had done that, then you would have parked your money temporarily in debt funds or duration funds. Many people who bring lump sum, what do? We put the money in a liquid fund and then gradually shift that money into equity. So whenever markets are volatile, you will get a chance to shift that money into equity under more favorable circumstances. So you take out some money from equity, park it in temporary low duration money market funds where you are still making good return, 6%, 6.5% you can make comfortably. And then from there you take the money into equity gradually and systematically. So your investment is done in an extremely disciplined way, which gives you opportunity out of every crisis. So this is how you have to deal with market volatility. So what are the themes of 2023? Let's go to the next slide to know what the themes are. First, you can do asset allocation strategies. Whether you can put little money in gold, little money in debt, little money in equity. In a nice balance, you can do that. When you do asset allocation strategies, some assets will give you 7% return, some assets will give you 9% return and some assets will give you slightly higher return. In a challenging year, I think you should actually target lower return and form a more balanced asset allocation strategy. Then when equity prices become more attractive, you can invest more in equity because India is a bright spot. And when global growth is low, India is having better domestic growth. So in that situation, you can have an asset allocation driven strategy where now you start with a certain asset allocation and gradually you make the asset allocation more aggressive. That is going to be what we are going to do. Now, I will give you what the key takeaway from this webinar is going to be. What I have told you till now is only a broad context about what you can do, how the year will be. I am anyway going to keep on talking to you about this. But this webinar is not exactly about that. That is just a context setting for you. But what this webinar is about is every employee in a formal job has a PAN card and an income tax assessment every year. So you have every year tax deductions and you also have government allowed tax deductions which help you to save money for the future. So typically, I'll give you a ballpark number. Every one of you can put 2.75 lakhs of money every year in tax deductions intelligently. You also have the option of creating a pension fund. Even in government job, there are no pensions today, whether state or central. So it is a duty of every one of you to use every year to prepare your finances for your retirement, for your life when you stop working. And the government is actually giving concessions every year. But what we have observed, because we have done thousands of plans, we have talked to so many people, what we have seen is that people are not using this efficiently. In M2W, we want all our clients to learn how to use the government tax deduction schemes efficiently to create a superb long-term corpus for yourself, which will become your retirement corpus. And we are firmly of the view that this itself will take care of it. Many of you are ready to even do over and above this. You are doing SIPs in equity funds, and I know you are participating in a number of thematic funds. That is separate. But you are also using this ATC, ATD, and other schemes, right? So, tax concession schemes which you are using can be used more efficiently and more effectively to create asset allocation and to create wealth within that. Today I am joined by my colleague Janaki Raman, who is going to take you through how to create an asset allocation within the existing tax deductions allowed by the government. So let us hear him. He has got some very clear data pointers, and then we will continue this conversation with each of you to help you become far more efficient than your social peers and for you to achieve what is the potential which you can accomplish through each tax deduction scheme. So you have to use the scheme to full efficiency. Government is giving it for your benefit, but 99% of the people are not using it properly for their benefit. We want to use these schemes itself to create a good corpus for you in addition to what you are doing otherwise. So this is like the icing on the cake, which so far we have been using very inefficiently, right? So over to Janaki Raman. Let him take you from the next slide and I will observe and join you at the end of the discussion.
Thank you, sir. A warm welcome to all and a good afternoon to all as well. Kindly move on to the next slide. So, tax is often seen in the Indian context as something that is both boring and complicated. But today we will see how to make use of this tax with the available ATC, ATD and ATCCD deductions to make a powerful portfolio. This can be a truly all-weather portfolio that can not only help you save tax, but also provide you protection such as health insurance and also help you create wealth over a long period of time. So today's topics would be how to create an asset allocation using the existing tax deductions that have been allowed by the government. Next slide. Now, these are the tax deductions that the Indian government is currently offering. So let's look at a brief summary of it. First of all, Section 80C, most of you would be aware of it. This gives you 1.5 lakhs tax deduction every year. So under this, you can claim stuff like ELSS, your PPF contributions. So both your EPF and your PPF contributions, as well as the premiums that are being paid for your term insurance. Secondly, let's look at Section 80D. Section 80D is often ignored, but this is very crucial because health insurance, if you go to a hospital, health insurance costs often end up running up very high. But Section 80D can not only help you to protect against these uncertainties, but can also help you to save tax. If you are under the age of 60, you can claim 25,000 for yourself as premiums paid for health insurance, and if you are over the age of 60, such as in the case of your parents, you can claim deductions up to 50,000 on the health insurance premium that is being paid. So totally we have 75,000 that can be claimed in a year for Section 80D deductions. And finally, something that is often overlooked or ignored is Section 80CCD 1B, which is your NPS. NPS is truly a very ignored product. It is one of the finest ways in India to build not only a retirement corpus that is tax efficient, but it also helps you to create an annuity income in your retired years. So totaling these three sections, you have close to 2.75 lakhs in tax deductions that you can claim every year. Kindly move on to the next slide. Okay, now let's look at how to make use of these deductions effectively. So I like to think of these deductions as three pillars of your tax portfolio. The first being term insurance, the second being your EPF or PPF contributions that are being deducted from your salary or the voluntary contributions that are being made, and the third being your ELSS funds or the equity component of your portfolio. Over this webinar, we will look at how each and every one of your product contributes not only to the tax deduction side, but also towards maximizing your portfolio and creating wealth for you. Next slide, please. Okay, now let's look at how to make use of these deductions effectively. First and foremost, term insurance. So term insurance is very, very crucial. Now, as you know, there is something called human life value that is attached to each and every one of your lives. Now, this is not the salary that you earn or the assets that you own. This is something that is far more. So this value is attached to each and every one of your lives. A term insurance of at least 1.5 to 2 crores is recommended for each and every earning individual. This is because in the case of any unforeseen circumstances, at least your dependents should not be left financially begging. So in that case, a term insurance is very highly recommended from our side. Secondly, let's look at your EPF or PPF contribution. Now, EPF, most of you would know, is a constant. That is, it is being deducted to the portion of 12% of your basic salary plus dearness allowance every month from your salary. Now, we know that this goes on, and this is a very good component for your retirement. One more thing that is often overlooked or that is not considered because of slightly lower returns is PPF. Now, PPF is a very, very important product, and it can help you to ride the volatility of the equity markets. So let's look at an example where what happens if you invest 50,000 every year in a public provident fund. Now the current interest rate comes out to 7.1% and there is a lock-in period of 15 years. At the end of the maturity, you are getting 14 lakhs, which is tax-free. PPF is a EEE product, meaning it is completely tax efficient. Whatever contributions you make is tax efficient, whatever interest you earn is tax efficient, and the maturity amount is also completely tax free. PPF can be thought of as an extension of EPF, where after your EPF, if you have more money that you would like to contribute to a debt instrument which is tax free and your tax slab also allows it, you can go for additional investments in PPF. And finally, next slide. And finally, let's also look at ELSS. ELSS in the Indian context is a very misunderstood product. So I'll tell you what most people do with ELSS. They invest it solely for the purpose of tax deduction at the final moment, and what they do is after the 3 years they end up redeeming this amount, not letting the process of compounding take place. This leads to two scenarios. Now what happens after the lock-in period is done, the ELSS amount, the markets end up going down. Your ELSS fund will not only go down, there can also be a capital loss. And the second scenario is you end up stopping the compounding process, which is the primary aspect of equity. Now let's look at an example where what happens if you don't stop the compounding process and what happens if you let it compound over a period of time. Compounding is often thought of as a snowball effect. It is just a small snowball at the top of the hill. But once it starts coming down, it keeps forming and forming and it becomes a very big avalanche. So we have constructed an example showing an SIP, that is a systematic investment plan where you invest every month in an ELSS fund running for a 3-year period, a 5-year period, a 10-year period and a 15-year period. So we have assumed that you contribute 12,000 per month. Of course, as your salary goes, it is recommended that you contribute more as well. And the rate of return that is assumed is a conservative 10%. So what most people do is they put it in for a period of 3 years and take it out at maturity. Assuming a rate of 10%, they would have got around 5 lakhs at maturity, which is a good amount. But now let's look at what happens if they had not stopped the compounding process. If they had let the train run, you see this snowball would have compounded and they would have got after 15 years they would have created a corpus of around 50 lakhs or even more if the rate of return had been higher. You see, stopping the compounding process early has resulted in a shortfall of 45 lakhs. Even if they had invested for a period of 10 or 12 years, they would have got handsomely around 25 to 30 lakhs. But since they had only done it for the purpose of tax solely and had taken the amount, they had lost 45 lakhs in the process. So this is a fine example of why you should let the compounding process take its own course and not stop it in its due course. Any more? Next slide. Okay. Now I have constructed an example where we look at a tax saving portfolio like a hybrid car. Now with the rise of EV and petrol competing against it, you see a lot of cars coming out as part electric and part petrol. Now let's look at how your tax saving portfolio can be compared towards it. So if you look at the Grand Vitara that has been launched by Maruti Suzuki lately under the flagship name Nexa, it is a smart hybrid product. Your tax saving portfolio can also be thought of as something similar. Equity is like the petrol that is fueling your long-term compounding. So it is giving you that extra oomph to get that higher returns over a longer period of time to help you create that massive wealth, to help your corpus grow. And the debt portion, which is your EPF and PPF. Next slide, please. And the debt portion, EPF, PPF, can be thought of as the EV portion or the electric portion, helping you to ride out the volatility of the equity markets. You see, equity markets, as Sir said, often tend to be very volatile. But fixed income instruments such as your public provident fund or EPF can help you smoothen out this volatility. Next slide, please. Okay, now coming to insurance. Now, a lot of Indians have become aware of health and term insurance, but most of them have not gone ahead with the purchase of such insurance, thinking, okay, maybe I can postpone it. Now let's look at an example where what postponing health insurance can lead to. Now we take an example of Ram. He's a 40-year-old tech employee. He had a child and his wife is a homemaker. He also has some aged parents who had diabetic and hypertension. In this case, Ram is the single earning member of his family, meaning anything happens to him, any illness he occurs, the income earning potential of the family would be impacted. So recently, Ram got diagnosed with the illness and he had to pay rupees 2 lakhs for the treatment. Now, thankfully, he had a comprehensive, adequate health insurance policy with a sum assured of 10 lakhs to cover him, with no room limits, no sub limits, no disease-wise limits. This has helped him to not only overcome the illness, but also pay very minimal amount out of his pocket. Now, what would have happened in the case that Ram didn't have this health insurance policy? You see, health insurance should not be taken only for the purpose of tax deduction. It is good that the government is giving us tax deduction for this health insurance, but your health is the primary asset of you and your family. So that should be safeguarded at any point in time. Next, please. Okay. A good life insurance should always be a term insurance. You see, there are a lot of other products in the market. For example, you have ULIPs, you have money back plans, you have endowment plans, you have guaranteed plans. All of these plans, they come with a very high premium, but also the level of sum assured that they give you tends to be quite low. A good life insurance, that is a good term insurance, not only is the premium amount considerably lower, but the sum assured that they give you is quite high. Next, let's look at health and critical illness. Health insurance we just talked about. So what is this critical illness? So for example, a critical illness policy can be bundled as a rider with term insurance. Critical illnesses such as heart diseases, cancer, etc. are diseases where the cost of the care is often very high. Bundling a critical illness as a rider with a term insurance not only is cost effective, but in the incident of these diseases can help you with a lump sum amount that can help with the hospitalization and the complex medical conditions and procedures that are often involved in diagnosing these illnesses. Next, please. Okay. Insurance is often your first line of defense. Just like the soldiers who are defending our border in Kargil, it helps secure you and your family during medical insurance, during medical emergencies. You are also entitled to tax benefits on the premium pay. So just as a brief, if you look at, if you are under the age of 60, you can claim tax deduction up to 25,000 every year. And if you're over the age of 60, such as in the case of your parents, you can claim tax deductions up to 50,000 per year. Not only do you save tax, but you also end up providing cover in the case of any uncertainties. Totaling this, you can save up to 75,000 every year as tax with health insurance. Next, please. Now, as I said before, NPS is often a very ignored product, and looking at it in much more detail has provided us with a much better view on how to look at the NPS and how not only can it help you to save tax, but can also help you to build a very good corpus for retirement. Excellent. Now, if you look at NPS, if for example, someone at the age of 30 decides they want to start saving for their retirement, and first thought on their head is to go for a NPS or a national pension scheme, since it's provided by the government. If you look at it, if the person had started a monthly contribution of 4,000 to 4,500 rupees every month, and assuming a rate of return of 10% over the 30 years, that is till the age of 60, that person would have accumulated a corpus of close to 1 to 1.1 crores. 60% of this NPS corpus is tax-free at withdrawal, so meaning you can get 60 lakhs as a lump sum in retirement, and with the remaining 40 lakhs you are entitled to get a pension also. So not only does the NPS help you to save tax, it also helps you to withdraw a lump sum at retirement which is tax-free, and also helps you to get a pension. By this way, NPS can help you to safeguard your retirement in such a way that you end up saving tax and you end up creating wealth over the 30 years towards retirement. Next slide, please. Okay. Now, as a fitting conclusion, we all know the story of Abhimanyu and Chakravayuha in the Mahabharata lesson. He knew how to get in, but didn't know how to get out of the defense formation. Similarly, you can think of the social media influencers and the fin twitters that are roaming around. These are people who give information on financial products without proper knowledge. You see, a bad financial product can cause investors a lot of damage. Not only can it cause capital erosion, but it can lead to your entire returns going down. The arrows that have hit Abhimanyu can be thought of as the products that are being sold in the market. You see investments such as ULIPs, which are market linked but have never provided a return more than 7 to 8%, small case investments which are precarious, LIC policies which not only not help you to save capital but don't even beat inflation, and option trading which is risky at best and doesn't help you to generate a good income over a long period of time, are some of the products that are being peddled by the social media influencers to the retail public. These are products that will completely destroy a person's financial wealth and can lead to a person being pushed into debt as well. As advisors, it is our role to help you in guiding you towards away from these products into more regulated and structured products to help you create wealth. So, with the help of these tax sections, I hope it would be clear so that you can create wealth using the available tax deductions as well as save for retirement. On to you, sir.
Thank you, Nakul. See, the main point that I want all of you to remember is that tax saving is not meant just to save taxes. That is only a small objective. The greater objective is, in 15 years, can I build a corpus? Let's say you're 21, 22. You start you doing your tax saving intelligently. Then at 35, 36, you will have money to buy a house, right? Because your PPF money alone will become 50 lakhs. So you can use that as your money, and you can, with low EMI, you can buy a house. So how you purpose tax saving is very, very important. According to me, 99% of the investors today don't purpose their tax saving at all. They just do tax saving for the sake of tax saving. Whereas what you should think of doing is tax saving for the sake of investment. That should be very, very important, and you should use your tax saving concessions very, very sensibly, smartly, and sharply. So that is where it is important for you to get good advice, and this webinar was organized mainly to impress upon all of you in this group that you can make your tax saving far more efficient by understanding your finances clearly and repurposing your tax savings. You should not take out the money first, what you put for 15 years. That is the first rule. The second rule is you must ensure you are adequately insured. The third rule is you must not miss out on investing for the pension also. That 50,000 you should not leave out. That is the third rule. The fourth rule is you should not buy products which are missold. Okay, like he mentioned in the last slide, where Abhimanyus get caught, you should not become Abhimanyu. What about VPF? VPF will give you 10%, 9 to 10% at best case. So whether you should do more than what is allowed for you is a question you must ask, because I feel that outside of that, if you invest, you can make 12% or 13%, which means your money can grow much faster if you don't over invest in VPF. But at least to the extent you are eligible, I feel you should invest in pension, in PF. Whether you should overdo PF is a question which you should ask yourself. I generally tell people to do what is needed, not more. That's one point. The second point, which okay, these are the basic points with respect to how you can make this tax savings more efficient. NPS is tax free for 60% redemption. That is correct. At the age of 60% you can take out. Kamlesh, that is the correct point. When can you get? You will not get the 40%. The 40% will be paid as pension to you, monthly pension in your lifetime to you and probably to your immediate dependent, which is your spouse. Probably that should also be there, right? Or is it not there?
It is that. It is a part of the annuity. You can choose it as.
Yeah. So it will only come as pension. You will not get the lump sum, Kumaresh. You can be sure about that. All right. So this is something which we want each of you to do. You can reach out to us and ask us how you can do it better. It's very important that we control this process by knowing clearly what you're doing. Okay. Otherwise, it will be random. I know a lot of you see videos here and there and do investing. My suggestion to you is this tax saving investment should be done in a very structured way. Don't do it randomly. Okay. So many people think that they are saving money by going and buying online and all that. It is not true. Most of the time you are buying the wrong products and actually the cost of that is much higher. In all this, you don't have a cost in PPF. You have a cost only in ELSS, and the cost in the other things are all very pension product. There are hardly any commission. So it's not a question of commission. It is a question of how efficiently you invest that money. That is more important than commissions. So cost actually is very low in this product. That is why nobody is coming to tell you to do this product. If there is a benefit, then people will come to sell to you. But no one will talk to you about this because these products are designed keeping you in mind. The government has ensured that you get these products at a very efficient price. But no one is using it, right? So you can understand why. It's because there is no incentive for people to tell you to do it. But we want you to do it because it's money put in your pocket by the government. Otherwise, you'll pay taxes, right? So I think that disciplined investing must be done. We want to ensure that you are doing it in a structured, disciplined way. If you are with us, then you must be very, very clear that you are doing it in a structured and disciplined way. That is what I want you to do. We can help you, Gokul. So you can talk to your advisor and you can talk to Nakul also. He will help you how to do this better. In a smaller group also, you can have a discussion through online and know how you can do this better. What we want to control in this is we want to ensure that you do the ELSS sensibly, first point. We want to ensure you invest for the pension. Monthly 4,500 we want you to invest. Good. We will make it, we will choose the product and give you a safe product and we will monitor the option also. In that product also there are risk options. So we will control the risk option also for you so that we do it in a way which gives efficient returns. That's very important. Just investing in a product is not enough. The return efficiency also we have to get out of that. The choice between PPF and ELSS, you have to make that choice. We will continuously help you. When we feel PPF is good, we will help you invest in the PPF. Otherwise, you can do a monthly transfer to PPF also, small sum, and the rest you can do in a lump sum later. When equity market is very high, that year we will want you to do more of PPF. When equity market is very attractively valued, that year we will tell you to do less PPF and more ELSS. All this balance, we will help you. That is what we will do. So broadly, this is the idea behind this webinar because we want you to use this 2.75 lakhs. Government is putting in your pocket every year most efficiently. I don't think you would have seen people telling you how to do this sensibly in a concerted way. We want to do that for you. That is the idea behind this webinar. Any other questions? So you have given us numerous questions. So I got nearly a huge number of questions. So is it okay to invest and forget behavior? I don't see. Not redeeming is one thing. Invest and forget is another thing. I am saying you must remain invested, but you cannot forget. You have to monitor the investment. That is the first question. Then the second question is how to stop worrying about taxation when booking profit or asset modification. I will answer this in a separate video. It is not the topic of this video. So there are numerous questions which you have asked about these, mostly about issues not related to this subject. Okay, so we will answer all these questions in short videos. So in M2W, we'll raise this question and give you a shorts video. In the shorts video, we'll answer all the questions you asked. Don't worry that all these questions are not answered today, but all the questions will be answered in shorts videos. I'll just pick up a few questions which we can answer now in the next 10 minutes. About FD rates still increase or not. I expect them to increase a little bit more this year. That's the first point. So you can expect FD rate to go up. Then somebody has asked whether we are assisting filing IT returns. We are not doing that. We don't help you with IT returns. That's one point. Do we expect changes in our existing investment portfolio in Milestones in 2023? We may add a few investments, but we won't change the existing investments. I don't advocate people investing in stocks directly up to 50 lakhs. I will tell you why. All of you got free portfolios from all over the world. You got coffee can, you got somebody else giving one portfolio, some popular FinTweet gave full portfolio. But what I observed, I will tell you, they keep changing their mind. Okay, often they book loss in these stocks. They tell I have sold, then you have to sell. No, this is a very indisciplined, haphazard way of investing for an investor to do. That is why I don't bring stocks into small investor portfolio. And stocks need to be controlled. It's like an electronic gadget. It has to be maintained perfectly, right? You cannot just buy stock and forget all that. People are giving gyan, but look at all these portfolios which are free. They have not done well at all. That's the point I'm trying to tell you. Why we have put up boring stocks is for you to compare how a good portfolio should be or a safe portfolio should be, but not to basically make you go and buy each stock. No, I'm not going to do that, because what I've seen is when people execute, they execute wrongly. They'll go and buy the stock when it is trading at high valuation. They will not buy when it is trading low. All sorts of funny things will happen. And then they'll feel bad about their investment because the investment is not going in the right direction. I believe that in funds you can make, it's very simple, my argument is very simple. In funds you can make 12%. If you make 12%, you will double your money in 6 years comfortably. So your 1 rupee will become 2 rupees in 6 years and 4 rupees in 12 years, right? Now, if we manage to do some more investments whenever the markets are in our favor in mutual fund, you can make your 1 rupee become 2 rupees in 5 years. If you are really good, if you buy small caps at the right time, not like you did in the last 2 years. If you buy it at the right time, then that will also add to your return. You may actually double your money in 4 years. If you double your money in 4 years, then 1 rupee becomes 2 rupees in 4 years. In 8 years, it becomes 4 rupees. 12 years, it becomes 8 rupees. And in 16 years, you make a lot of money. Ideally, you should try to work between these two limits, where in 15 years, you are able to make 4x or 8x and 16x. So you need to decide how you are going to do this. Okay, it's a wide range. Okay, in this wide range, what will decide your success is your behavior, your discipline, and how you are guided through this process. So that is why I am saying that if you have to do so much to get that return, I don't think randomly buying stocks is going to make you successful unless you are able to put so much time and effort into that, right? So, like I must have, for 20 years, I must have done only that, thinking that, okay, then for me, that works as an investment. But you are having careers, you're doing so many things. For you, I think that products are good enough. You can do a sensible job. There's a huge swipe of products available. And you should buy the right product. You should not buy the wrong product. That's very, very important. So, I'm not going to bring in any stocks into these portfolios. I have given those stocks just for your analysis. Somebody who wants to learn about stocks can study these companies and learn. It's only educational, purely. Then what are the other questions? Is Franklin Templeton something is safe? Of course it is safe. It is safe. They have returned all the monies in debt. It is absolutely safe. There is absolutely no problem with Franklin Templeton. Which tax regime can be applied when income above 30 lakhs, especially no home loan or EMI? Is Gen C's question. Jagiraman, do you want to answer that?
Yeah, in the case where you don't have any home loans or EMIs, the new tax regime will have slightly lower tax.
So that answers Gen C's question, new tax regime. Tax planning for salaried as a self-employed for the pension aspect especially. Shibi is asking, over to you.
Okay, tax planning for salaried as well as for self-employed person, you'll have something called 44AD or 44ADA in case of a professional. You can make use of those. Your existing tax deductions will also be present there. The NPS aspect is also there. Sir, under ETC, ELSS, PPF, EPF, term insurance, all put together limit is 1.5 lakhs. Yes, correct. The all put together limit of all these 4 instruments is 1.5 lakhs.
See, individual stock portfolio less than 5 lakhs. What would be our advice? My advice would be leave the good stocks, sell the bad stocks, put that money in mutual fund. If you have some very good stocks, I will leave it. Okay. The bad stocks, I will sell and put it in mutual fund and I will be peaceful. There is no need for me to take stock risk. I will still make 10, 12%, 14% return if I invest smartly. Any session in Tamil, we will do a session in Tamil Karthik shortly. Then I doubt if my tax saving amount comes to 25% of my monthly income and the same 25%, no, clarify to him. He's saying that tax saving amount comes to 25%. Gokul is asking a question. Can you?
First session, by doubt, my tax saving amount comes to 25% of my monthly income, and the same 25% I'm already investing in SIPs. How to manage? So you can invest in the ELSS funds. This will help you to not only save tax, but something like NPS can also be considered to save that additional 50,000. Do you help in choosing health insurance product? Yes, sir. We do offer support in choosing health insurance product.
So we not only help in choosing the health insurance product, we also maintain the policy, remind you to pay the premium. In the event of some claim, help you with the claim, all that we do. Okay, so you can get your health insurance need fully fulfilled at our end comfortably.
We can also help with term insurance as well.
How many funds would be added to M2? I don't know. There could be rebalancing in the future. There could be. I won't rule it out. But how many I will add, I don't know. It depends on the market. If I see something very attractive, I will tell you to do a lump sum in that. That's how we work. So there is nothing premeditated. Suppose something becomes very attractive, I will call you. Who knows? I may ask you to even buy something which I am telling you today not to buy. In course of the year, we will tell you to buy that. Okay. I am an NPS account holder. My company also makes a contribution. How to make automated investment similar to SIP under personal category. So we can help you through the mutual funds itself. MP, I don't know what is your name, but we can help you through the mutual funds to do this. Like you do SIP in mutual fund, we can do the monthly 4,000, right? That should not be a problem. What is your recommendation on NPS allocation between E, C, and G for present scenario? Auto or active? Active choice. Always active, no auto. So we will choose one option now, and whenever stock market comes down, we will change the option. That's what we will do, Arul. That is how we want you to make the 10%. Otherwise, your return will go to 6 or 7%. Remember that. NPS won't perform if it is done mechanically or if it is done auto. It won't happen. We should actively manage it. That's what I feel. So once in a year, we may have to change the option, which they allow, right? Janakiraman, they allow you to change the option, right?
Yes, they do. Yes, they allow you to change the option twice a year.
Yeah. On a lighter note, have I watched the newer? Yes, I watched the newer. And I'm very appreciative of the economic advice given to the director and also the intelligence of the director. If he invests like this, he will become a pauper.
Long-term capital gain up to 1 lakh can be done yearly for tax saving rate. Also for doubt is separate LTCG for stock and separate LTCG for mutual. So yes, 1 lakh up to 1 lakh LTCG, you don't have to pay any tax. There is no separate LTCG for stocks and mutual funds. Both combined you get 1 lakh.
So I will also advise all of you that after the budget, again, Nakul will come with a webinar if there are changes, okay, to tell you what the budget means to you. Please attend it and make all your friends in M2W also attend it, because you should know and update yourself what are the tax changes. So it will take probably half an hour, 40 minutes after the budget, and please attend it so that you know what is the impact. And I'll ask them to give it to you within a day or two after the budget. Okay. So please make it a point to attend. Otherwise, you'll make a video. Please see the video. If there's no webinar, there'll be a video. Please see it. It's very, very important for you to know what the budgetary changes mean to you. And if there is any change in this strategy, we'll come and tell you because the government makes some changes. I expect some concessions for the salaried class. Hopefully, they don't disappoint like in the past.
Instead of PPF, can we go for Suganya Samriddhi scheme with 7.6% return for tax savings?
If the child is very young, yes.
Yeah.
It makes sense. But that money will go to the kid. So that's a good way, definitely.
So, question for you. In 2019, I invested in Access ELSS, but it is not performing. Lock-in period also over. Should I continue, or I need to switch that amount to different fund?
So you have to switch it into a fund which you will not touch. Okay, so I think that that is the thing. What people do now in the switching, the problem, this is where choosing ELSS is very important. If you choose a dud ELSS, this is what will happen. Most people choose dud ELSS. It's important to choose a good product, stick to it. And if suppose for some reason that product fund manager changes, performance is bad after 3-4 years, that money should be moved into another product which you will never touch. So you should have one product in which all the ELS money is moved and you never touch it. Mentally, you must never touch it. That is very important, Manivasan. The point is, if you take this money and put it somewhere else and then it goes into car EMI and then goes into Diwali holiday, then you're gone. You can't move that money into anything else. So the problem has been that the products of some mutual fund houses have not been good and they have not performed. Then you have to go to the winning house and stick to them. And you must monitor whether they are doing well also. So if the lock-in period is over, this money should not go into some other expenditure. It has to go into compounding. That is why this whole webinar is organized, Manivasan. I hope you understand that. So you can probably put it into your M2W portfolio and not touch it again. That is possible. Any other questions? Thank you very much for coming in this webinar and participating. If you still have questions, you can email us and have a nice weekend and see you soon after the budget. Thank you so much.
Thank you all.